everyone. I'm Carol Speakerman, president of Speakerman Retail. Last week, we got an important retail barometer reading that retail watchers eagerly anticipate. I'm talking about the 1-2 punch of second quarter earnings reports from Walmart and Target. As usual, they came in one day apart, and Walmart led the charge. But this isn't just about two mega retailers duking it out for dominance. It's really a bellwether for the entire retail industry. So I thought it was a perfect time to look at what they have in common, where their strategies are diverging, and what it might signal for retail as a whole as we head into the make or break holiday shopping season. Now for Target, their profitability was down 90% year over year, but they also managed to eke out a 2.6% increase in sales, which was just enough to keep their 21-quarter growth streak going. Customer traffic was up 2.7%. Which may not seem like a lot, but it equated to 90 million new visits to Target land. For Walmart, their comp sales were up 7.2% year over year. E-commerce leaped 12%, and Sam's Club's comp sales, really you could say they were the jewel in the crown because they had a 13.9% increase. Walmart's international business racked up a 5.7% gain, and overall revenue was up 8.4%. Now, this is a number everybody's talking about because they beat analysts' forecasts. And I think the general consensus was that in typical humble Walmart fashion, they underpromised and over-delivered for the quarter. But in the pain department, there were two great unifiers, and that is supply chain snags and inflation. Both retailers had plenty to say about that. And I'm going to blow all of this out in my next episode of Speakerman Speaks Retail, which is my podcast. But today, I want to focus on three takeaways that I think are less discussed, but very important. First of all, mix matters. Here I'm talking about category mix. And I actually really love the term that Walmart coined and used several times in its report when they talked about mix shifts. In fact, they cited unfavorable mix shifts as the culprit for their 132 basis point margin dive. Translation. Low margin groceries are great for driving traffic, but does everybody have to load up and head out? What about those yoga pants? Yep, sales in those discretionary, more profitable categories like apparel were soft and inventory levels were uncomfortably high. Now, Target had a margin dip as well. Their gross profit margin represented 21.5% of sales this year, which compared to 30.4% last year. But Target took pains to say that mix really wasn't a big factor in their margin performance. Instead, they cited upticks in what they call frequency categories. Well, of course, grocery is one of those frequency categories, and it's a category that Target's been very focused on because it's what drives the traffic that can help boost sales of those discretionary categories like apparel and home that Target's very well known for. But Target placed a lot of the blame on markdowns in categories like home furnishings that were really on fire last year, but not necessarily so hot this year, or at least not to the levels that Target bought into them. But the big takeaway here is that retailers are still selling stuff and shoppers are still buying stuff. But what they're buying has a really big impact on profitability and on performance for retailers. And thanks to those pesky mix shifts, past performance is in no way indicative of future results. And increasingly, past performance can't be used to plan future results. So that word unprecedented, I think, continues to be the elephant in the room. Now, for my second takeaway, I'm going to lean into one of my top retail trajectories. And it's really just become a mantra in retail, or at least for me and when I talk to folks about what's happening in retail. And that is diversify or die. Both Walmart and Target validated this once again in both of their reports. And business model diversification, I'll say it again, it really is the engine that's driving retail's future. Then you layer on format and category and geographic diversification, and they really become the sprinkles on top. But either way, diversification into these non-product businesses are a powerful hedge against product-based headwinds like inflation and supply chain problems. And when it comes to business model diversification, Walmart was downright giddy about its ad business, and for good reason. It grew 30% in this quarter. In fact, their new CFO, John Rainey, summed it up by saying that despite short-term challenges, they continue to diversify their income streams. And their ad business is a big part of those diversified income streams. The translation here, though, is that increasingly solutions, services, and ad slinging in particular are saving retailers assets. You're going to see this more and more as retailers go mad for ads and build out their ad platforms. And in terms of what drives all of that, Walmart, you may have heard, recently announced that they added Paramount Essentials as a freebie, if you will, to their Walmart Plus program. And just a couple of days ago, they threw in a points-based rewards program. But what's happening here is, like Amazon, Walmart can take the bucks coming and going. They can charge customers to participate in these loyalty programs and get all those perks, but they also can turn around and sell access to those shoppers to their suppliers and brand partners through their ad platforms. So pretty nice business if you can get it, and it's a great business model. Interestingly, though, Target's Roundel ad platform is pretty robust as well, but they weren't talking as much about it. And perhaps they didn't want to disclose a lot of the details, but instead they talked about 15% growth in what they called their other revenue line. But in true Target fashion and what we're used to seeing, they were really crowing about and very outspoken about their brand partnerships with Marvel, which impacts entertainment and product, exclusives that they have with Lego, and those wonderful Ulta shop-in-shops that they've been rolling out that really promise to turn Target into a true beauty destination. So as far as Target's concerned, I think it's really great that they're diversifying out of that designer partnership model that was very pioneering at the time, but frankly has become played out. Either way, diversify or die is still my main mantra. And the shift to solutions and services and non-product businesses is a huge driver for it. Now, my last takeaway is flying so far under the radar, but I think it's really important, so I'm going to surface it. We know that excess inventory was a problem for Walmart and Target. We talked about that. Now, Walmart CEO Doug McMillon talked about how they canceled billions of dollars in order commitments with their suppliers in order to help make it go away and to not have it perpetuate. Target CEO Brian Cornell cited what he called their bold effort to do the same thing, to get rid of that inventory. So basically, Target took the approach of gobbling the spinach up all at once and also partnering with suppliers for those future commitments to make sure that they were in a better position going forward. So the end game was to make sure that this wasn't going to drag out and wasn't going to drag down performance for Walmart or Target. But here's the thing. Excess inventory also compromises newness. Now, this is a term that you hear a lot at Target, and increasingly you're hearing it more at Walmart. But for Target in particular, they really exemplify my third takeaway, and that is newness ain't nothing. Because for Target, again, in particular, that is their entire brand premise, is having constant inflows of new products, new brand partnerships. And if you've got a bunch of musty old inventory hanging around, it directly impacts that ability to deliver newness. So desperate times called for desperate measures. And the bright side is, I think, that barring any more miscalculations going into the holiday season, I think Target and Walmart are very well poised, having sort of ripped off the Band-Aid and having dealt with some of those problems with their inventory. So out with the old and in with the newness. So what have we learned? Well, mainly that just general sales numbers don't really tell the story. Mix matters, and getting the mix right is really critical to retailers' profitability. Again, it's not just about overall sales. It's about getting that mix right and calculating it. And I think now they have some really great data from back to school, too, that they can carry into the holiday season and make better decisions. Also, diversification in its many forms is the growth engine for retail going forward, and it's a powerful hedge against some of those product-based problems that aren't going to go away anytime soon. And finally, any barriers to newness have to be knocked out. Either that, if they aren't, you're compromising full price sales and even your entire brand reputation. So stay tuned for more updates. I'm going to be tracking this all the way through the end of the year, and thanks for listening in.